Thank you for joining us at XM.com. This is a special report regarding inflation. I'm Christina Marujos. With me today is lead investment analyst Rafi Boyajian. Rafi, it's evident that we're seeing a surge in inflation across the major economies, but central banks like the Fed believe that any inflationary episode will be transitory. However, the rapid spread of the Delta variant is making investors rethink about their rosy growth predictions, which has also started to weigh on inflation expectations. Therefore, how worried should we be about inflation becoming sticky?
Well, Christina, that is indeed a very good question, and what many investors and many policymakers are asking. So we're seeing the supply shortages, the bottlenecks that were created from those lockdowns we had last year and earlier this year. They're really causing a lot of problems in the entire supply chain, and it's becoming much more widespread than it first appeared to be. We're seeing as also commodity prices surging, and all this is combined with this pent-up demand where we had that period of lockdowns where people weren't really spending, they were saving, and we also had all the fiscal stimulus as well, which added to people's savings. Now all of this is being unleashed, and as a result we're seeing a surge in demand on particular goods and services. For example, in the US, we're currently seeing a summer travel boom where everybody wants to enjoy their summer holidays now that a lot of the restrictions have been lifted, and this has led to, for example, big demand for used cars as well as rented cars, and that's why we're seeing a particular surge in certain sectors of the economy. The question is how quickly, though, can these temporary issues be resolved, and how much further will prices rise before they start to ease? So quite a bit of uncertainty as to how long this transitory period will be, and when inflation does fall back, will it fall back to, say, around 2%, or will it stay slightly elevated?
Now, looking at bond markets, however, virus fears seem to be the primary concern right now, and this has led to a slump in yields as well as boosted traditional safe havens, with the US dollar gaining especially on the back of this. As markets are rarely a win-win arena, what currencies could suffer the most in such an environment?
Well, it is interesting with bond yields because they were in fact falling since June, and slump accelerated over the past week as we saw those virus jitters resurface. And so safe havens such as the yen, the Swiss franc, and of course the US dollar have been the main winners in the FX markets, and riskier currencies such as the pound and the Aussie have taken a slightly worse hit. Now, the reason why these two currencies stand out is because in the UK, Boris Johnson is taking a gamble by lifting almost all restrictions and relying on vaccines to do the work. But hospitalizations in the UK have now started to rise, and they're raising some alarm bells because infections have surged so much in the past few weeks that it's inevitable that even with a country with a high vaccine rate, hospitalizations will at some point start to rise as well. And so if we do see a return of tough restrictions, then we could see the pound slump even further. And that's why many traders are predicting now that probably going to be inevitable because of this Delta variant. Infections continue to rise, that some restrictions will have to be reimposed. So that's why the pound is at particular risk, because it had rallied on the back of hopes of the reopening of the UK economy. And if we see those expectations being pared back, then inevitably that's going to lead to a weaker pound. Now, as far as the Australian dollar is concerned, up until now, the Aussie had a fairly good time because Australia hadn't really been that affected by the pandemic. But now the Delta variant is becoming difficult to contain, and there's a real risk that's going to take some time for those lockdowns to be lifted. And what that means for the Australian recovery is that it's going to be another bump on the road, and it could even impact RBA policy. So the RBA has slightly slowed its bond purchases at its last meeting. We could see at the very least those bond purchases lasting much longer, and in the worst case scenario, those bond purchases might be reversed, and we could see RBA ramping up its bond purchases. And if that were to happen, that would be even more negative for the Aussie.
And speaking of central banks, if we don't see virus numbers come down in the upcoming weeks and the Delta outbreak worsens, possibly sweeping the US as well, what would that mean for Fed policy? How significantly would that affect the growth outlook in the United States? And would that ease concerns about inflation? Or should we be worried about both weaker growth and higher inflation?
Well, luckily for the Fed, policymakers still have a bit of time before they reach a final decision of whether or not to taper. And so the Fed is expected to discuss tapering during the summer, but a lot can change in the next few weeks. The Fed could in fact be facing the dilemma of, on the one hand, improving economic data, particularly in the jobs market and the labor market, but virus cases could rise at a somewhat worrying rate. If the Delta variant does start to get out of control in the US, the Fed might delay a decision on tapering, or if they do taper, they might do so at a very gradual pace. Now, this could weigh on the dollar, but overall, as long as Delta fears persist around the world, the dollar will be supported by safe haven flows, so it's unlikely to suffer much even if the situation in the US were to get worse. But another worry is what you just mentioned there, is if we end up in a situation with both weaker growth and higher inflation, because if it does become clear that vaccines are not as effective as hoped in limiting infections, and the world moves away from lifting restrictions to reimposing them as we head into the colder months, we could see more supply chain disruptions, and this time around there would be a greater risk of inflation becoming stickier. In addition, we're likely to see a more modest fiscal stimulus in future lockdowns, so we could end up with stagflation, which is a world where growth is sluggish and inflation is high.
Rafi, thank you for joining me today, and thank you for watching the special report on inflation here at XM.com.